Okay, welcome everybody. I hope you hear me. Can you hear us? Please let us know. Yes. Okay, Professor Galai, do you hear me?
Yes, I hear you very well.
Great. So welcome everybody. It is my pleasure to kick off the second series of webinars with our own experts from the Hebrew University. What better people are there to offer us valuable insight into what is going on during this difficult period of urgency and unrest? Although it's natural to think about the implication of the coronavirus on public health, the economic crisis is becoming an urgent concern to everybody. Professor Dan Galai from the Hebrew University's Jerusalem School of Business Administration is an expert in finance, financial engineering, and risk management. His webinar will focus on the effects of the coronavirus on the economies and financial markets. Thank you to all for participating, and Prof. Galai, the floor is yours.
Thank you very much. Good evening. For some of you, maybe good morning, and welcome to this webinar. So I'm going to talk about the effect of the coronavirus on the economies on a global basis and on the financial markets. Okay, so first of all, we should all realize that we are really a global village. We went through globalization over the last 30 years, China joining about 20 years ago, and the global village has positive as well as negative aspects. One of them is a speedy spread of the coronavirus across many countries. Still, we have some issues, and we cannot explain how come the rate of the pandemic is different across different countries. We see countries like Germany, Russia, India, where the rate is relatively low, and mortality, for example, in Germany is very low, versus Italy, Spain, France, the UK, where actually the rate is very high and it's very rapidly developing. So we don't know the explanation. And again, I'm not a medical expert, so I'm not going to dwell on it, but it's an interesting issue that has also economic implications, of course. So the contagious effect is even more intensive and rapid across financial markets. We see the effect spilling over across really all the major stock exchanges, bond exchanges, and indices are crashing by 30, 35%. And I'll talk more about it, and especially about the fear issue, fear index. So today also the economies are very much connected. We have the outsourcing, we have the supply chain. A lot of products are coming from China, from the Far East in general. So everybody's connected. We are talking about connectedness. And so in effect, in one place, or something that happens in one place is also affecting other markets. And we see it especially in the exchanges, the different exchanges. And actually what is ruling now, what is dominating the world is the uncertainty, the fear. And the uncertainty is on, I'll talk about the three factors: medical, economic, and financial. So for medical, the medical uncertainty is actually, nobody can tell us how long will it last. Is it going to be contained within 1, 2, until September? Summer will affect it. So nobody can tell us yet how long will it last. Then the depth of the pandemic, and that the depth will be measured by the number of serious cases and the pressure on the health system in different countries. And we see that some of the health systems are crashing, are collapsing, like in Italy. So it's maybe in some parts of United States may face it. So the depth is again, something that nobody can tell us for sure. And behind it, the background is what is the probability of a second and third waves. Some predict that maybe it will come back next winter and will hit most of the populations. Angela Merkel predicted that 70% of the German population will contact the coronavirus. So nobody exactly knows the probabilities and the extent of the medical issues and how serious will it be in different markets. Economic-wise, economic uncertainty, it's hard to estimate what is the impact on the macroeconomy measured in terms of the GDP, the gross domestic product. And I'll talk more about it, but the question is really related to the first uncertainty, the medical one. How long will it last? So we'll defer it and talk more about it. Then we can talk about the effect on specific industries. We see that it's affecting dramatically different industries, and also government steps are helping or affecting also industries that are not necessarily directly affected in the first circle, the first wave. So we see the tourism industry actually collapsing all over the world. Again, the case of the pharma industry that is striving or doing well, but not much affected. Then we have the impact on SMBs. SMBs are small, medium-sized businesses that are also going to crash, and professional self-employed individuals that have, the business is shutting down. And again, they don't know for how long and whether they can sustain it, the economic pressure that they are facing. They have to pay rent, they have to pay maybe to employees, and there is no income. You look at the tourism industry, they lost all the income, and it's not something that is recoverable, as we'll see soon. And again, each effect like that is immediately translated into unemployment. The third phase of uncertainty is in the financial markets. We see the impact on the exchanges. As I said, drop of 30%. Remember, it's really pretty major, because if you look at the GFC of 2007 to 2009, the markets went by about 50%. Now we are 30, and in some places even more. One of the major crashes, which was even more, it was in October 2000 with the internet bubble. The Nasdaq over 2 years crashed by 80%, but that was more unique case. And we can't, again, compare the different crises that are completely different. And then we have the effect on credit risk. Credit risk means the ability of borrowers to continue and pay the debts. And we see a huge surge already in credit risk by different measures. And the reflection of all of it is in the fear index, and I'll elaborate much more on the fear index in the coming slides. And the problem is that no one has any clue about the length and depth of the crisis. And the markets, therefore, are dominated by fear and anxiety. No other way to describe it that in one day, the Dow Jones can lose 12%, or the S&P index can lose 12%, and then the next day it will go up by 7 or 8%. So it's really, everything's translating into volatilities between pessimistic and optimistic views. And the bottom line is that at this stage, nobody can tell us where we stand. So as I said, I'm not a medical expert, so I'm not going to talk about the medical issues. Those are some positive news coming from Singapore, Taiwan, Korea, and even from China. Korea, that had some very high numbers, seems to have contained it. Also Singapore taking different measures, Taiwan. And China, we see that after 2-3 months, they are opening the factories and telling people to go back to work. So those are maybe positive news. However, we get every day very pessimistic news coming from Italy, from Spain. Spain is really speeding like almost Italy in the number of deaths. France, UK, and especially what is worrisome is the situation in the United States, which didn't take much measures. And we see the Washington State, California, New York being affected in a major way. So, again, we have mixed news, and so far there is no visibility, and therefore we stay with a lot of uncertainty. So we see whole industries collapsing. The first one was, of course, the tourism industry that stopped in a day. Related is 2 weeks later, the entertainment business, airlines, transportation, and more. And what we've seen in some of the industries, some of the losses may be recoverable, but those that lost all the income, all hotels that closed down, all the airlines that stopped flying, they lost income, which is non-recoverable. And that's a situation that we didn't have in previous economic crises. We didn't see an industry that actually stopped completely its operation. And so it's not that we can learn much from previous crises to understand what's going on now and how the future will look like. And it's in circles. So we have immediately the first circle that was affected. Now we have the second circle. The second circle are the shopping malls. Once you close the shops, shopping malls in all places are in trouble. Then we have the car and plane production, different industries serving the tourism industry. Remember that the tourism industry is by now the largest industry on a global basis, and it's the one expanding the fastest. And once it stopped, the number of people employed, they're all being fired, laid off, and coming to ask for unemployment compensation wherever you have such a system. So the unemployment rate already in the United States is jumping to over 10% from 4% just a month ago to over 10%, but easily it will reach in a month or two, it will be 20-25%. Hopefully it's not going to be permanent, but very transitory, something that can change rapidly once we see the end, once we have better visibility about the length of the crisis, the pandemic. Then we may see third, fourth circles, and to some extent those depend on government policies as far as isolation and trying to put more people in isolation, and as a result, like a curfew that can be to different degrees, can be partially, can be completely, but it will affect many other industries that are not necessarily affected by now. So another major wave of unemployment will be caused by closing non-essential businesses in order to prevent the spread of the pandemic. Levered firms that took loans will be pushed toward insolvency. And I see all kinds of measures that show that within a month, the spreads that indicate credit risk are jumping through the roof. And we see the banks, even though they are being asked to be more lenient and to give more money, are actually becoming much less willing to give loans and to renew loans. So that's this issue is affecting mainly firms that depended on loans. Loans are great. Leverage is great during normal times, good times. It's a killer during a crisis, during recession. So all the above factors that I mentioned so far lead to recessionary pressures. So while the economies were booming over the last 10 years, now suddenly, within a month, we see major predictions of a recession, and I'll talk more about it. So the issue, as I said, is whether it's going to be temporary or whether it's going to be more permanent. What effects will stay with us, and what can be recovered. Again, the one-time losses, nobody will recover. But the question is whether the medical uncertainty will be a 1 month affair, 3 months, or 6 months affair. So in the economies in Western Europe, I believe that if we'll go back to work by the end of April, the economic damage can be contained with a loss to gross domestic product, the GDP of 1 to 2%. And unemployment, the permanent part, will go up by 4% from the current level. But if it takes all the way to the end of June, the numbers can easily double, and pressure may spill over to 2021. So it's really, you see, the numbers may change dramatically depending on how long the pandemic will continue. And a key factor indicator is when global air traffic will resume its almost full operation. Today, all the airlines are idle. It's closing down. Even in those countries where they continue, it's going to stop very soon. So the key factor for recovery is when the airlines will start flying again. Think about the growth in global traffic over the last 10 years, and suddenly it's all being stopped to understand where we stand now economic-wise on a global basis. So some industries can recuperate, can recover faster than others. It will take the tourism industry, for example, 6 to 12 months to recover. The problem with many SMBs, they will collapse in the meantime and not sure whether they can recuperate. By the way, in China, they estimate that more than 1 million businesses have already collapsed due to the crisis in China, which started by the end of December 2019. Shopping mall and retail businesses can recover faster. Sports, entertainment, restaurants will recover first. All will change if a second wave of the coronavirus will erupt next winter, of course. So that's something that for the time being we don't want to talk about. We are all concerned and focusing on this first wave of the coronavirus. What government should do, in my view? So the speedy recovery depends on the length of the crisis. I think that monetary measures, you see, the government has monetary and fiscal measures and tools that they can use. I believe that monetary measures, such as reducing interest rates, are not effective at all. And as an evidence, on the day that the Fed reduced the interest rate to close to zero actually, the S&P actually collapsed by 12%. So yes, it can be a signal that the Fed is going to help and to provide additional assistance, but as a tool, reducing interest rate, I think, is completely ineffective. Yes, the central banks must assure the stability of major commercial banks, and they have to see that actually the commercial banks in their regions, in their countries, are stable, not announcing any dividends, but maintaining high amount of equity ratio. And the central banks have to provide liquidity as much as needed to the financial markets. For example, by purchasing bonds, government bonds, even industrial bonds, and to do it as much as needed as possible. And by the way, if you look at the governor, the head of the Fed, Greenspan, in 1987, when the stock market crashed in one day on October 19th, 87 by 22%, Greenspan immediately announced that he will open the doors of the Fed to any bank that needs liquidity. Even such an announcement had an effect on the markets. And within a few days, the markets recovered. Also, he did the same in the 9/11, again, announcing that the central bank will provide liquidity as much as needed. Because in time of crisis, liquidity is a king. People are rushing to liquidity. So that's a major factor that is in the hands of the central banks and the commercial banks, allowing this process to work properly even in time of crisis. But mainly, the major tools are the fiscal measures, and they're essential. First of all, the government should offer unemployment benefits to the masses of people that hopefully will be only temporarily laid off. They have to support SMBs, the small and medium-sized businesses, and self-employed. If not, they will have many that will collapse without any way to recuperate. So they have to provide them with some help. And to assist companies and businesses that were forced to shut down, like hotels, restaurants, entertainment, sports, etc. Now, I know, and I was asked by by Ellie Simon about the potential of inflation. So again, it's not something that I would recommend during normal times. I got my PhD from the University of Chicago at the time of Milton Friedman and Stigler and other, experts in economy and finance, pretty conservative school, which didn't believe in government intervention, but that's different from any other crisis over the last 100 years. And therefore, I believe that such measures are needed and increasing even the public expenses and the deficits. And inflation is not a worry at this stage. No, I don't expect inflation, and I think that we have enough tools, so the central banks have enough tools later on to neutralize it after the crisis is over. So again, it's not recommended in normal times, but in such times as this crisis, yes, I would highly recommend it. So we can deal with the deficit and the inflation after overcoming the current crisis, which is not stemming from mistaken economic policies, but from a pandemic. You see, the economists usually, the textbooks are talking about normal economic life, then there are some mistakes made or some other economic forces that lead to a recession. And then, yes, we have all kinds of recipes how to come out of recession. But this is a completely different crisis, and therefore it should be treated, and we should think about it differently. And I think that we'll have enough time to deal with some of the after effects of government assistance. Now, what I want to deal with, to tell you about, is the fear index. That's one of the major gauges to measure economic uncertainty. The VIX index, as you see at the bottom of the slide, was originally invented and proposed by Menachem Brenner and myself. We proposed it to the American Stock Exchange in '86 and to the CBOE Chicago Board Options Exchange in August '87. We were maybe too early, but by '92, if I'm not mistaken, the CBOE started to measure the VIX index, and only in the 2004-06 they start to provide financial products, which are very popular today. So the VIX index is derived from options traded on the S&P Standard & Poor's index of 500 major stocks in the United States, and you have similar indices for sub-industries and also in many other countries. You have similar indices which measure the volatility in the financial markets. And therefore they are called the fear index because they sort of reflect the fear in the financial markets. So we can translate it, the VIX index, into the cost of purchasing insurance contract on the index, on the major stock index. Put options, that's as a footnote for those that know better about options. So put options are insurance contract protecting the buyer from declines in the index. Okay, and the price of the put options is really determined by the volatility, by the uncertainty. So we can derive from the put and call options actually the amount of uncertainty in the market. So the more volatile is the market, the higher will be the index. And the more expensive is the cost of insurance. And remember, it's done continuously during trading days. Every minute, the price may change. So it's really the most sensitive looking forward index that we have to gauge uncertainty. So it's a very sensitive one. And therefore, as I said, known as the fear index, but it really provides you with information all the time, and you can see, easily monitor the changes in the trends. So here you have the behavior of the VIX index going back to 1990, okay? And you see the major spike in 2008, reaching 80 points. That was the Lehman Brothers collapse on September 15th, 2008. You see some spikes in 2010 and 12. Those are the European sovereign bond crisis. And again, it jumped to something over 40%. Before we see some effects of the 2000, the Nasdaq crash and the 9/11. But again, the levels usually, even during previous crises, reach something like 50%. Only after Lehman Brothers and the current crisis that we see levels of 80%, which is extremely, extremely high. During normal times, if you look at before, if you look at 2017, 18, usually it was about between 10 and 15% only. So jumping to 80 means sevenfold, eightfold the extent of the fear in the marketplace. So some of the features of the fear index is that, first of all, it's the only index, almost the only index that is forward-looking. You don't fill questionnaire, you don't ask people how they feel about the future, but you measure it from traded options. And the price of the options reflect the expected volatility until the option's expiration. Second advantage of the VIX is that it's based on actual prices of liquid options. So it's not something rare or something that you have to look for. It's all the time under the lamp. We have trading, very intensive trading, and people pay and vote with the money. So it's more accurate, and people pay, and remember, it's two-sided. So one pay, one receives. It's a zero-sum game in this respect. So the prices are the best indication of how people feel, What are the sentiments? And we are talking about professionals. So they actually provide the information to the marketplace. Okay? And the third advantage that you have it continuously, and you need one transaction to reflect all the changes about 500 stocks if we talk about the United States S&P 500. So you don't have to trade 500 stocks. You can do it in one shot, one option, and the VIX index is being updated. So it's very highly recommended to follow the VIX index, especially during time of crisis, and verify that when markets are coming down. And I'll show you where they are now soon. Okay, in normal times, the VIX, as I said, is between 10 and 20. And the VIX now is the highest levels experienced since launching the index. And you have here the previous event that I was talking about, the October 87, when it reached 80, but within a day or two, it started to fall to 35. During the LTCM crisis, August, September 98, it stays below 90. Also during the bubble crash in October 2000, also 9/11 crisis. It peaked in September, October, following the Lehman Brothers collapse, because the market were, if you remember, were in panic. And actually it was the Fed involvement in providing liquidity and then the government help in fiscal policies, the different programs to help the financial markets, the banks and the commercial banks, and mainly investment banks. But also in a few days, it recovered from the 80% going down to more normal levels. Now it's high and staying high for almost 3 weeks. Remember that on February 21, a month ago, it was below 20. Now for 3 weeks, it's really high and staying high. So you can see here the one month's view. And you see that more or less from March 10, more or less, it reached already 50. And for 3 weeks, 2 weeks, if we look from the 10, it's staying above 50. It never happened before in the history of the VIX. So it shows you what I started my talk about, the amount of uncertainty in the marketplace. So the uncertainty is derived or driven by medical issues, but you see the translation into the financial markets. So what are the conclusions before we will answer your questions? It's a different kind of economic financial crisis from what we have experienced over the last 100 years. We never had such a crisis, pandemic, translated in economic crisis, translated into financial crisis. It is dominated by uncertainty and fear due to medical uncertainty. Many businesses are going to collapse within a short period of time unless government offer generous, consistent, and well-planned economic packages. You see, I don't like government programs shooting from the hip or doing it in sort of a haphazard way, not well planned. Yes, we should have the best brains trying to devise packages that can be offered very soon, but in a way that will help in the medium term the economy without having bad consequences later on. So we have to take everything into consideration, but yes, we should open the pockets of the governments to help those businesses that suffer, and it's not stemming from bad management, taking different bad moves. Usually I'm not for helping companies that took the bad turns, bad strategy. It's nothing to do with the strategy. We can deal with the cost of potential economic consequences after the pandemic is over. Follow the VIX and the likes, I mean the sub-indices, to see what happens in different industries, to identify change of trends. And crisis is always an opportunity. And the question is, which industries, firms will gain in the medium long term? And I'm not concerned here about the short term, and I don't think that people should, unless you are very opportunistic, but I don't believe in the short-term investments. But the question is, what will change on Earth globally in the different economies that raise new opportunities? Many good firms are oversold only because they are liquid, and let me deal with this issue. What happens, and that we saw very clearly in 2007, 2009 in the GFC, the crisis, there were many mutual funds, pension funds that needed to liquidate their positions because of the pressure from the members, from the shareholders in mutual funds or pension holders in pension funds. Now, when they need liquidity, they didn't necessarily sell the bad shares or the poor companies in the portfolio, because usually those were completely illiquid. So they were selling actually good companies, liquid companies, and they put pressure, selling pressure on those companies that lost value beyond, they were oversold because of their liquidity. So if you look at some of the statistics in a paradoxically way, some poor companies, they didn't show much volatility, didn't show much risk during the 2007, 8, 9, because nobody was selling them. Because if you throw into the market even a small quantity of shares, the market would drop by 50%. So why to do it? It doesn't provide you with liquidity. So that's something that we should be very careful from doing, liquidating those stocks. At this point, after the market already went down by 30 something percent, if you don't need liquidity, stay in the market, assuming you have a quality portfolio. Of course, always, if you don't have good companies, sell them. If they are good for the long run, stay with them. To take actions in the stock market out of panic, I think at the end of the day, it's not rational. Yes, we have uncertainty. Yes, the markets did extremely well over the last 1-2 years. In some markets, even the last 10 years. So yes, we went back 2-3 years back, but it's not the end of the world yet. So I hope that also medically we'll be able to survive it sooner than later to overcome the crisis. And once we do it and we have better visibility, I hope that the economic measures taken by the governments will help to stabilize the situation. And once it's over, hopefully in the short term, I think that most businesses can recuperate and continue to grow. And therefore, the consequences for the stock market is also don't sell under panic, only if you need liquidity, and look for opportunities. If you want to see the VIX index in Tel Aviv, we start to publish it, the Tel Aviv Stock Exchange, about 1.5 years ago. So here you see actually of the last, from the last year, it's a 1 year view. And again, you see it was very, very low, around 10% most of the year of 2019. And now over the last month, it's 70, 80 still. The same pictures in the United States, very high and staying high. Thank you very much. Now we'll take some questions. So we have 3 participants. Let me see that I can take the questions. How do I do it with the questions?
Okay, I will allow Lirom Motula to speak. Lirom? Hello?
In the meantime, I had a question before from Ellie Simon. So one question was about the inflation, if I'm not concerned about inflation, and the answer is no. Over the last 10 years, we don't have any inflationary pressures. The price of oil is, being below 20. And by the way, I didn't talk about the commodities, especially oil, which is another issue, interesting issue that we can talk about if you have questions. But at this stage, I don't expect much inflationary pressures. Actually, the inflation rate is too low. Interest rate now in the United States going back to zero, in some other places also going back to zero, is not good for the economy in the long run. I think that the interest rate government risk-free should stabilize at 1-2% per annum for the medium range. Think about all the people saving for pensions. If the government is dropping interest on government bonds to such low levels, all the people on retirement will suffer tremendously because the savings are not going to be sufficient. So inflation is not a concern at this stage. We can contain it. Another question of Ellie was about export impairment, whether different countries will concentrate more on local production and we'll see less of outsourcing. I'm not concerned. It will be marginal, but I think at the end of the day, the world will go back to normal unless there will be some political measures taken against some countries. But I don't think it's economic wise. It's a wise from economic point of view to do it. And another question from Derek, the stock clapper, whether the private sector can play a role. Yes, of course, but it's limited because of the government restrictions. So, it's not that the government will stop all the airlines under its control, but somebody will fly, privately. So we have to follow the government regulation. So it's restricting the ability of the private sector to play a role. But of course, with the recovery, yes, absolutely. And the second question he asked was about the ESG-driven companies. ESG, for those listeners, it's for environmental, social, and corporate governance issues. So companies that follow some of the rules, the more what is considered to be more acceptable, corporate governance rules, etc. Whether they are going to, are they in better position? So some research shows that even before the crisis, that they were in better position. So I'm not sure that it's related. It shows that the quality of management, and usually if you have better quality of management, you will be able to survive it in a better way. So it's they both stem from the same source, from quality of management.
Okay, we have now Moti Anavi. I allowed you to talk, Mr. Anavi. Mr.
Hello?
Anavi, hello?
Don't be
Can
on
you hear
mute,
me?
Anavi. Yeah.
Great. Thank you very much for a very interesting presentation. One thing that you mentioned during the presentation is that currently fiscal policy, like reducing interest rate, doesn't really affect the markets.
Monetary policy doesn't affect the market, yes.
Right. Do you see monetary policy affecting the recovery? So day after, you know, once the medical issue gets resolved, how do you see that affecting the recovery?
I don't think it's going to be a major factor. You know, for me, if government short-term interest rate is going to zero, being 0.5% or 1%, is almost irrelevant. We saw it for many years that the Fed has kept the interest rate very low, around 0% to 0.25%. It wasn't very helpful. It was really the world trade and different other factors that helped the economy in the United States. I don't think that the interest rate had a major impact. It took more than 10 years to recuperate from the GFC.
So which fiscal or monetary policy do you think would be helpful for a recovery?
Monetary, as I said, to buy, for example, bonds, to support bonds also of private company. I mean, bonds traded in the market were to supply liquidity to, as I said, to pension funds, mutual funds, maybe hedge funds that are heavy investors in bonds, not necessarily government bonds, but also government bonds. In some countries, maybe also government buying some foreign currency in order to, again, to allow more liquidity in local currency into the market. For example, in Israel, we have a lot of foreign reserves, and you know, the bank can be quite generous in this respect. And also, as I said, to promise to have enough liquidity to whenever it's needed. Now, I believe that what is more urgent is actually the fiscal policy to help small, medium-sized businesses, to help some of the industries that are on the verge of collapse.
Thank you very much.
Welcome.
Okay, we have now William Levis. Mr. Levis.
Yes.
Unmute him. Yeah.
I'm unmuted. My question is, I'm a self-employed attorney and an entertainer, and I'm 73 years old. Most of my money is in the bank, fairly liquid. Is this the time to stay that way, or to buy stocks or bonds, since they're bottoming out? When they're bottoming out, they're going down. As a self-employed person, I'm cut off my income now. The courts are closed,
Sure.
the restaurants are closed, and nobody seems to be talking about, we are a small business, but they don't count us as
No, I mentioned it, the self-employed. I have it in the slide. Absolutely. No, I said that the government should offer some help to self-employed, especially maybe the younger ones that didn't accumulate any fat, any reserves. But again, it's something that should be dealt with and planned, well planned. Now, I think that the opportunities will be, first of all, in the bond market, in traded bonds. As I said, because of the liquidity pressure, so many bonds lost value dramatically. You know, I can tell you from my experience, in January 2019, when the market was so depressed and still continued down, I wrote a letter to our clients at Sigma. I'm a partner in an investment house that I established in 1992. But I wrote a letter telling people it's one in a lifetime opportunity to buy bonds now. High-rated, good bonds that fell so much. You see, a bond with 5-year maturity that fell by 5%, 10%, 20%, you get rate of return over those 5 years that is fantastic. So you take small risk and you are getting a lot of return. So to be very selective in selecting the bonds, and that will be the first step. Again, everybody is buying now Zoom. Everybody is using Zoom like us now. Okay, so Zoom is already skyrocketed, the price per share. But after the crisis is over and universities, schools will go back to normal teaching in class, yes, there will be demand for Zoom, but not as we see today. So again, to do some extrapolation from time of crisis, pandemic, is not a good way to try to base prediction for the future about the value of the company. But I think that you'll have enough opportunities in the bond market, carefully selecting the bonds that actually lost value only because of being liquid. Thank you.
We have now Mr. Shilub. Hello?
I want to thank very much the speaker for a wonderful presentation. I'm very curious about a kind of personal investment opportunity or liability from his standpoint. Specifically, would you invest in the airlines industry with cash that you have or maintain the cash liquidity? How would you rate the risk and the benefit for something like that? Not short term, not even midterm, but long term.
No doubt that the airline industry will recover and will be, will recuperate a lot of the losses in value of the stocks. But the issue here is that the uncertainty is really also concerning not only the length of the time until they are going to operate again, but what will be the government package. In some countries, they talk about nationalizing some of the airlines. In some places, I don't know if Mr. Trump will provide a package to United Airlines or to Delta, and in what form. So it's something that us as economists, we are unable to predict. Everybody can predict in the same way what will be the form, the shape of the package. So if you know that a government, French, Italy, whatever, will provide a major help to the airlines, yes, you can try to run before it and get a position. But if not, they may allow some of them to collapse and to be taken by somebody else. Maybe Buffett will buy now an airline. Who knows? But
All
it's
right.
really no. It's a casino game in this respect. The airlines.
Right.
But once we see that we see the end of the crisis, when we have better visibility, and we know some of the airlines that they have enough cash to withstand it, yes, it will be an opportunity.
Do you think that would be triggered by a sudden drop in the fear index?
Yes, absolutely. Once we see it's going down and stabilizing, it's a little bit, as I said, it never happened before that it went for such a long time at such high levels. And again, you have some sub-VIX indices following different industries. It's interesting to see what are the differences. I'm sure that the pharma is much lower than the airlines.
Thank you
And by
very
the way,
much.
banks seems to be quite stable. By the way, I'm not only banks, but if we look at the P2P platforms, some of them will be hit in a major way. You know, the new fintech companies that provide loans, mainly to small, medium-sized businesses, the bankruptcy rate can be skyrocketing. Banks also will suffer some losses, but I think that most of the banks are better equipped today to deal with it.
Okay, so now we have Joel Levy. Joel? Hello, Joel?
Can you hear me now? Hello?
Yes.
Good. We in the United States and probably the whole world are following very closely, to the extent that we have news, about the negotiations taking place in the Senate about the package that will be offered.
Yes.
And I'm just curious as to your reaction to the response by the Democrats, and specifically as articulated by Schumer and Elizabeth Warren, saying they're not opposed to the bailout, as it were, of the major industries of the banks, et cetera, but that there are not sufficient protections, as I understood it, for the individuals, for employees, guarantees of employment and so on. As I understand your presentation, I would think you would say that the Democrats are correct, that the package is a bit flawed until those protections are provided. And could you confirm that that's correct or clarify?
What I said, and again, I don't know exactly what the Democrats and Schumer said, but I think that the packages should be, first of all, to the unemployed. And again, depending on how long it will last, the crisis, but those that were fired from all the employees in restaurants, for sure they don't have enough savings, and they will need an immediate economic help. Small, medium-sized businesses, and the major businesses should be on case-by-case basis, on industry-by-industry basis. But yes, you know, to the unemployed, you should give a grant, unemployment, you know, a compensation, like usually it's being done in many countries. To businesses, maybe it can be in form of loans, subsidized loans, loans over a period of time. But again, there are different ways to do it.
Thank you very much.
Welcome.
Okay, we have now Jacob Gelman. Mr. Gelman?
Yes, I'm here. So I have two questions. How do you see the economic crisis developing in the Israeli economy? And what might be the difference in sectors with the economic crisis in USA? What parallels do you see? What things will go different in Israel economy? That's my first question. And my second question is, do you see the American authorities buying equities in the stock markets? Do you see the Israeli authorities buying equities in the Tel Aviv stock exchange?
So I'll start with the second question. No, I don't see them buying stocks. I can see them buying bonds and less supporting the stock market directly. I think that once they provide more liquidity, and you know, the stock market is better equipped for volatility. As I said, in previous crises, stocks went down by 50% over the last 50 years. I think more than 3 or 4 times, they experienced a loss of 50%. And if you look at the Nasdaq, it crashed by 80%. It took 20 years to recuperate. So, you know, those markets are volatile. Investors know they are volatile. That's fine. As I said, in the bond market is a different story. And I think they should supply liquidity in the bond market. Now, as far as the Israeli and American economies, first of all, we see that at least the severity in Israel so far is much less than in the United States. It started a little bit earlier, or detected earlier in Israel than we got it straight from Italy. I think in the United States, it took another week or two, but we have only one dead person, unfortunately, but when you look at the mortality rate, it's very low. And it seems that once they identify people early enough, they give them treatment that is life-saving. So the pandemic was treated differently in Israel than in the United States. The fact that in the United States only last week they stopped schools. In Israel, it was already 3 weeks ago. So the measures were taken differently in the different stages of the pandemic. Now about the industries, airline is airline, tourism is tourism. We had a very good year in 2019, 4.5 million people came. The tourist industry was booming, and suddenly it's stopping. So fortunately enough, maybe, since 2019 was so good, they have some reserves, so they can go for 3, 4, 5 months, maybe without much help or some loans. But if it will be longer, it can be devastating, especially for hotel chains that are highly levered. So again, you have to do it industry by industry. The pharma, also in Israel, I think can withstand it. High tech, as far as I can see, and I'm involved in few startups, they're okay. Most of them raised money over the last year or two, so they can withstand some of the shocks. And for the immediate term, they may find better workers, experts at much lower price. So efficiency can go up actually in the startup business, which is really one of the major industries in Israel today, supporting the economy. And whatever is in the middle, it depends on government steps, what they're going to do next.
Thank you.
We have one last question of Jonathan Lux. Mr. Lux? Hello?
Hello from
Yes.
the UK. Good evening, and thank you for the excellent presentation,
Thank you.
which even I, as a non-economist, was able to follow. My question relates to the exchange rate, which was standing at roughly 3.4 shekels to the dollar pre-coronavirus.
Yes.
To ask, because I consider that a useful barometer for all sorts of things, where you see that in, well, firstly,
Sorry? Hello?
Okay, I think
The question was concerning the exchange rate. So for those that are not exactly in the familiar, the exchange rate in Israel before the crisis was 3.45 shekels to the dollar, and now it's 360, 65, went to even 370. But it's a tolerance within which the economy is operating well. 3.7 for exporters is much better than 3.4. And I think that once the crisis is over, the shekel again will become strong due to two major industries: the startup industry, the high-tech industry, and the oil production in Tamar and Leviathan, which are producing more income in foreign countries and saving to Israel a lot of expenses to buy energy. But at this stage, it's within the tolerance of the economy. I don't know if this was a question, but that was the answer.